Lecture 5 of Module 8, we're going to be talking about the redistribution effects of inflation. So, as we've been talking about inflation, the prices of goods and services in the economy are all increasing. And so, in general, we think that that doesn't sound like a good thing, but let's talk about the effect inflation has. And in some cases, it's not going to hurt people, it's actually going to help them. Others are going to be unaffected by inflation. So, let's go through and talk about how inflation can affect different groups. To start this conversation, we have to go back to the idea again of real and nominal. So when we're referring to real and nominal income, it's very similar to the discussion that we had on real and nominal GDP. So nominal income is going to be the income that somebody quotes you. So let's say that somebody offers you after graduation to pay you $50,000. Well, $50,000 might sound like a great salary, or you're pretty okay with that in somewhere like Columbia, South Carolina. But let's say that your job is earning you $50,000 in some place like New York City. All of a sudden, that $50,000 doesn't make as much sense because it's not going to be able to buy you as many goods and services in New York City as it will in Columbia. And so, nominal income is just this quoted income level. So, $50,000. Real income starts to give us context. And so real income is going to be our nominal income adjusted for inflation. So how has the purchasing power is going to be a term that's going to come up a lot in this lecture, but it's the value, how valuable are these dollars that we're getting. So real income adjusts our nominal income based on inflation. So if your boss comes up to you, this is the question. Your boss comes up to you and says, I'm going to give you a 10% raise this year. And on the face value, that sounds great. But what if the inflation rate is actually 12%? Or in that one example, we had 40%. All of a sudden, your 40% nominal increase in your wage is not allowing you to buy more goods and services relative to what you could last year. And so what we're thinking about then is the percent change in our nominal income, subtract out that inflation rate or the percent change in the price level, and that's what we get is our percent change in real income. So our nominal income adjusted for inflation is known as that real income. So we want to think about how our income changes over time and how does that compare to the change in the price level or our inflation rate. And as we see that, we'll see how can our purchasing power of the goods and services we buy, how does that change over time? And hopefully what's really important is seeing our real income increase, not just our nominal income. All right, so anticipating inflation, we all know that inflation will occur, and as we stated, that most people in the United States expect a very low inflation rate. The Federal Reserve targets something like a 3% inflation. And so people have these expectations that yes, our money will be worth less each year. And it's not just individual households. Financial institutions also are going to recognize this. And when we're setting interest rates on things like loans or savings accounts, they adjust those rates based on their expectations for inflation. So just as we talked about changes in our nominal income and our real income, we also have what we call nominal interest rates and real interest rates. And so our nominal interest rate is the quoted interest rate. So when you drive by the bank and it says handing out car loans for 2.5%, or if somebody says invest in this CD at the bank and you'll get an interest rate of 4%, that's the quoted interest rate, and that is not corrected for inflation. So they're not taking into they're not directly talking about inflation in that nominal interest rate. The real interest rate is the nominal interest rate corrected for inflation, and that's how the value of that investment. So let's say you're depositing money into your savings account. The real interest rate that you earn on that savings account is how the value of that money has changed over time in terms of the goods and services it can purchase. So let's say that in year one, you have $100 in the account. You have, let's say, a 4% interest rate on this account, and the inflation rate is 1%. So the quoted, the nominal interest rate will be 4, but we have to adjust it and recognize that, well, 1%, all of the goods and the services in the economy have increased in price by 1%. So even though I have 4% more money, I can only purchase 3% more in terms of real goods and services. So nominal interest rate minus that changing price level or the inflation rate is going to be the real interest rate. So the real interest rate is the nominal interest rate adjusted for inflation. So very similar equation to our previous example with income, but now we're talking about nominal interest rates, real interest rates. All right, so who is hurt by unexpected inflation? So what happens when we get our expectations wrong? In the United States, we expect a 3% inflation. What if all of a sudden inflation was actually 5%? Who is hurt by unexpected inflation? First, fixed income receivers. So at the University of South Carolina, I sign a contract and they tell me you will earn X amount of dollars for the next 3 years. And so I earn a fixed income and I am actually hurt by unexpected inflation. As inflation increases, the purchasing power of my money goes down, right? I have a 0% increase in my income. That's the nominal increase in my income for the next 3 years. If inflation is unexpectedly high, then what I'm going to see is my real income is actually going to fall. And so fixed income receivers are going to be hurt by unexpected inflation. Also, savers. People who are saving up for retirement also hurt by unexpected inflation. This is because they base their savings on the expected interest rate that they're going to receive. And yes, they already take into account, okay, I know my nominal interest rate. I know there's going to be some inflation, but what if inflation is unexpectedly high? If it's unexpectedly high, that's going to actually cause the real interest rate that the savers expected to fall. And as that falls, that means that their purchasing power on that future money is actually going to fall. And so savers are hurt by unexpected inflation. And finally, creditors or lenders. So the people who are lending you money for your student loans are hurt because they, again, lent you money at a nominal interest rate expecting inflation to be something like 3%. If it's actually 5%, then the real amount that they're earning on that loan that you're paying back on that loan is going to be less. So the dollars you're paying them back are less valuable than the ones that they lent you. And so creditors and lenders also hurt by unexpected inflation. So on the other side, who's unaffected by inflation? Those flexible income receivers and those with COLA ties. So those who can easily adjust their wages are going to be unaffected by inflation. Also, those with COLA ties are going to be unaffected by inflation because they have those adjustments. They have the ability to make those adjustments along with inflation. So if your income is tied to the COLA, then as inflation increases, your income will also increase automatically. Flexible income receivers can negotiate for changes in those prices, changes in those wages. And then who is helped by unexpected inflation? Most likely you are. If you have student loans, you will be helped by unexpected inflation. What do we mean by that? Well, again, the same way that our lenders are hurt, this benefits borrowers. So people who have borrowed money, the dollars that they're paying back are going to be worth less than the dollars that they borrowed. And so even taking into account this, the fact that we have this real interest rate that's charged, that real interest rate will actually be lower than expected. And so what we see are anyone who has borrowed money is going to be helped by unexpected inflation because things like their wages will adjust, but it won't be likely that the lender will come and say, well, now that the inflation rate was higher, I actually need to charge you a couple percentages more on your loan. Unless you have a variable interest rate loan, your fixed interest rate loan, that's not going to happen. All right, so let's look at an example of thinking about anticipating inflation. So we deposit $1,000 for 1 year. The nominal interest rate is 9%. During that year, inflation is 3.5%. And so what is the real rate of interest? So we deposit $1,000 in our account. And so what that means is that I have $1,000 in my account at the start of the year. and I expect it to increase in value by 9%. 9% is the nominal, the quoted interest rate. And so it does increase in value by 9%, but how much can that really buy me? Well, there was actually a 3.5% increase in the inflation rate. And so the price of all goods and services went up by 3.5%. And so even though the value of this account went up by 9%, it has something like $1,090 in it. 3.5% is the amount that goods and services went up in value. And so that leads me then to a real interest rate. The real purchasing power of my money has increased by 5.5%. So even though my bank account has 9% more in it, the value of the goods and services that I'm able to purchase with that $1,000 plus interest only went up by 5.5%. Okay, so thinking about the difference between the balance in the account versus the value that can buy us. So 9% was the increase in the balance, but the actual value of those dollars is 5.5% increased. And that's just the nominal interest rate minus the real, minus the inflation rate is that real rate. All right, let's look at a couple more examples. And what I would like you to do now is pause it, try and answer these two questions, and then we'll come back together and see if you answered them correctly. All right, so hopefully you went through these two questions on your own and then now are coming back to see if you answered those correctly. So a lender informs you that you will be paying 4.5% interest on a loan that you are applying for. This rate is known as, is it known as the nominal or the real interest rate? It is known as the nominal interest. Oh, now I am getting nominal interest rate, and that's an M there. Sorry, it doesn't look very clear. But nominal rate, this is the nominal interest rate because this is the interest rate that the lender is quoting you. So it's the quote, then it is adjusted. So suppose that the inflation rate was something like 3%. That would mean that the real interest rate on this loan would be 1.5%. The nominal minus the inflation rate gives us the real. All right, suppose a bank wants to earn a 3% real return on their investment and they expect inflation to be 2%. What nominal interest rate should they charge the borrower? So in this case, we are given the real interest rate, we're given the inflation rate, and we want to know what is the nominal. So remember, nominal is equal to, nominal minus inflation, I don't want to rearrange that on us this time, is equal to the real. So we know that they want to earn a 3% real, and we know inflation is 2%. So the question is, what is nominal? If we add the 2% to both sides, if we add inflation to both sides, we're going to see that the nominal interest rate should be 5%. Okay, and that's nominal interest, and now I'm going to write down what I was going to. Nominal interest rate is equal to the real rate plus that inflation premium. So they want to charge a little bit more to cover the fact that inflation occurs. All right, so whenever you're given real and inflation, you can add them two together to get the nominal rate. All right, so for more examples of this, definitely go check out the worksheet and practice problems for this section. Oh, before we finish, I thought that was the last slide, but it's not. There are other costs of inflation. So it's not just that income is redistributed, and it's not just that people like creditors are hurt by unexpected inflation, whereas borrowers are helped. There are other costs of inflation. And so first are what we call shoe leather costs. And so individuals often take time and resources and they spend those time and resources to guard themselves against the effect of inflation. So they attempt to protect themselves. Maybe that's by getting their paycheck more often, Maybe it's by purchasing things in smaller quantities over a shorter period of time so that their money doesn't decrease in value too quickly, but they take extra time and resources to guard themselves against inflation. Again, this is less likely in some place like the United States where we have a relatively low inflation rate, but when we get into a discussion of very high inflation rates, we're going to talk a lot more about shoe leather costs. Then money illusion. Consumers misinterpret nominal changes as real changes. So again, when your boss comes in and tells you that you earned a 10% increase in your wage, that's great, but it's important to recognize, okay, what is the inflation rate and how has the real purchasing power of that money changed? Then we have menu costs, and this is inflation means that firms have to incur extra costs to print new menus, to change the prices of their goods that they offer. And so there are costs associated on the firm's end of changing the prices, and they need to change the prices by printing out new menus. Again, this is going to be less costly over time as we see more firms moving to things like electronic menus and just a less cost there, but there are costs associated with changing prices. Uncertainty, so thinking about if the inflation rate is unexpected, I'm less likely to enter into that contract with some place like University of South Carolina that wants me to sign a 3-year contract at a fixed wage because I'm not sure what that money will actually be worth at the end of the 3 years. Price confusion. Inflation often makes it difficult to interpret prices. So not only do menu costs change, but it's hard to understand what the value of things are if the inflation rate is high. And then finally, inflation often means that our wages are going to increase as well. So with the prices of goods and services increasing, our wages increase as well, typically by the amount of the inflation. And this causes us then to move into higher tax brackets. And it can cause us to sell assets and incur larger capital gains than what the real terms actually mean. And so this increased tax burden is another cost of inflation, moving us up into another tax bracket, not because we have more money in real terms, but because it looks like more money because that is inflated. Those incomes are inflated. All right, so some additional costs of inflation to touch on. All right, so that concludes